Hi, everyone. This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. We've got a very special guest today. We're joined by Mike McGlone, who is a BI analyst based in Miami. He is one of our senior macro strategists, and we're going to have a very fun conversation with him. As usual, we've got Sally Omaz in Dubai. We've got Will Hares and Patricio Alvarez here in London with me, and we've got Fernando Valle joining from New York. So we're going to do the best we can to work everyone into the conversation. These calls have been growing in popularity. So if you are a new joiner, we do hold these on the first and third Wednesday of every month at this time. So tell your friends, tell your colleagues. We are more than happy to get the word out with anyone who might be interested. In addition to this call, we have a BI client chat that is very focused on the energy sector. So if you're not a participant in that now and you would like to be, reach out to any one of us on the call. We can help to get you included there. We also have mailing list. We have research that we regularly publish. If you somehow are unfamiliar, you can find it on BI Go, but we're happy to help you navigate all of that. So also, I would lastly just say if you're a regular listener and you like the call, but you think we should talk about different topics, or you think should cover something that we haven't, we are happy to try to work that in. If you've got suggestions for speakers as well, just let us know. So with that in mind, we're going to start off with some perspective on the oil market. And the last time we had Mike on, I just went back and watched a brief clip of it earlier today. And Mike, when you were on last time, oil was over $110 a barrel last May. And you talked about the potential for $50 oil at the time. I think directionally, the price peaked a little after you were on, and then it's been sliding or sideways ever since, and we're roughly 87 today. So given where we are at the moment, I want to talk about your latest outlook. Give us your sense. Where do we head from where we are today?
Oh, thanks for remembering that one, because I know I get plenty of them wrong. And it was part of that pain. I think we're tilting towards this trend towards normalization in commodities, which is they almost always get cheap during recessions. And the key thing is we're heading towards a recession. That's almost indisputable. And the question is, how do we prevent that? I don't know what's going to prevent it. And the key fact I like to point out is this is a very rare situation that we have the most central banks in history tightening, which I'm showing in this chart in the inverted curve, and the Bloomberg Economics GDP tracker just hovering on zero. So to me, when I hear supply and demand and earnings and anything else, I think these things are becoming less relevant compared, and even China opening compared to this is the 10 on a global basis. And that's why I can just depict it in the chart now, unshare that. But you just show what I'm showing is the most inverted curve ever. That's the Bloomberg Global Aggregate 10 minus 3 year. And the GDP tracker hovering on zero. So it's not really that, to me, that complicated. But what we're having right now, I think this year, is your classic hopium short-term bounces that always happen as you tilt towards recessions. And to me, that's what's happening. Like just the data we saw today in the U.S., everything missed in terms of weaker. And that's what happens recessions. You have to have demand estimate revisions tilt downward for inflation, for economic growth, for PPI, for industrial production. It's all going that way. And the key thing that I've never seen in my career, early a little bit in 1994 during that tightening cycle, is the Fed Reserve still hiking into a known recession. So to me, that's the macro, and then everything else fits in there. So let's look what's happened this year. We've had one of the biggest bouncing commodity markets has been Bitcoin. Why it went down the most? Crude oil is basically unchanged. Copper's gone up the most, but I think what they're doing is doing classic knee-jerk reaction, and it's basically trend versus trade. These are trades. The trend is something's got to stop this trajectory of declining global GDP, increased interest rates, more basically just taking the punch bowl away, taking liquidity away on a global basis for this to not continue. And that's, to me, is the basis. So I fully expect crude oil is going to get down to around $50 a barrel. That's WTI, maybe 40. That's a normal correction in crude oil. When it gets too high, it goes too low, and I can, just point those out. And it's the best way to really look at those is you look at a ROC, a rate of change, and overlay with recessions and what's happened in the past. So we're seeing the classic examples of demand destruction. Most notably here, the key thing I pointed out in June was U.S. unleaded gas demand going down. So I like to think to myself, is what stops this? And maybe this will help open it up for the group. Right now, I see tightening liquidity everywhere. And I think some of the best performing assets this year will be gold and U.S. Treasury long bonds and maybe eventually Bitcoin. And the key question is what stops it. So I'll leave you some of I think the S&P 500 is going to head towards 3,000. It's very much not profound in a recession. And actually, I have Gina Martin Adams, who's pointed out that the signals are all really bad. She's our chief equity strategist. And I think WTI will head towards 50. With that, I pass it back to you.
Okay, thank you. That's very provocative. So I'll just point out, you've got a note from last week that talks about the title of it is Significance of Crude Oil Bear Market Should Not Be Understated. And I want to come to Solly next, because Solly put out a note just the other day, yesterday, that says oil fair value closer to 90 despite persistent recession fears. And I would just say, Solly, I'm going to tee you up by just noting that you've been a bit more bullish in the past, and you're now talking about oil potentially going sideways for the next couple of quarters based on this fair value model that you've built. So talk about the fair value model and how does it contrast with what we just heard from Mike?
Sure, thank you, Rob, and always a pleasure to hear Mike's perspectives on the oil market as well. And I do remember that last call, and as you say, we were much more bullish than Mike was, and huge kudos to Mike for getting that right. I would like to point out, before I go on to talk about the oil fair value model and what we look at that and what the model has been telling us this last update in the last week, I think there were two major moves in the oil market that we didn't expect, and I think many didn't expect to happen in the last year or so. And one was Russia. Well, I mean, that was a huge uncertainty. And what happens to Russian supply, how much disruption we get in the Russian space. We absolutely overestimated how much disruption there would be. I mean, in the very beginning, how much disruption there would be to Russian supply due to just self-sanctioning. We overestimated that. And then towards the end of the year, there were actual sanctions by the EU. And we thought by then there would be a lot more disruption, a lot more tumbling in Russian exports, which just did not really materialize. And I think this must be one of the biggest surprises in the market, at least to us. The second one obviously was China, and the just persistence of lockdowns throughout 2022 obviously really weighed on oil demand and was one of the other major factors keeping oil at much lower levels than we were expecting in our core and kind of faster growth scenarios. Anyway, looking now at the market and what the oil fair value model is telling us, and this is, by the way, a Python model that we built with our data science team that's looking at a bunch of different factors, trying to get the best fit historically, and keeping those factors steady. It's trying to tell us where the fair value might be currently and in the next couple of quarters. And as you say, we are seeing a sideways move. I mean, when we published the fair value model was saying Brent might be at around $88 a barrel. Brent at the time was about 84. It's coming closer to 88. But for the first half of the year, our thesis right now is, we will probably continue to see continued pressure, recessionary pressures. And also China reopening may sound very bullish when you hear it, but in the very near term, probably in the first quarter and second quarter, this will probably mean much higher COVID cases. So we see sideways movements in the first half, perhaps going down a little bit. But in the second half, if China really does fully reopen, we see this as a very bullish factor. And we saw OPEC's report come out, the first monthly report for 2023. We had IEA's report come out today, the first monthly report of this year. And they both seem to agree kind of with our underlying thesis that after a little bit of a bumpy ride in the first half, demand is expected to go to pretty much record levels towards the end of the year. So very long answer, but the basic thesis is that I mean, there are some upside risks, but still recessionary pressures in the next quarter and the second quarter. But then we expect significant demand boost from China reopening and more international flights in the second half of the year.
Mike, I want to come back to you and get a little bit of response on just the concepts that might feed into a fair value model. A couple of variables that you might think of as important for oil would be value of the dollar and also what the Fed is up to. I think you might have some perspective on both of those, and kind of how do you see some of those more macro signals, playing into the market, particularly in 1H and even further out?
Correlation to the stock market. Don't forget that one. When I was at a hedge fund, and the hedge funds I've worked with as clients, when you do your value at risk models, you got crude oil right next to the stock market because they're highly correlated. That's just the way things are. I can show you any analysis, most notably since 2008, and they're all linked more so than they have been in the past. The key thing that's also changed from the past is the elasticity of supply and demand. I have to point out a little thing. I can point out some of my old geezerness. 1976, Mr. Strezzo's social science class, I did a report on the energy crisis. It was a big deal. And I remember the focus was all about supply this, supply that. So when they were running out of energy, and I heard it again when I was running Commodities S&P, every time I hear it, it's when markets put in big peaks. So it's one thing I remembered is I look at energy and things like it's the invisible hand is the most powerful force ever in terms of crude oil. And actually, I come from a farming background. You really see that in prices of corn and soybeans. Every time prices go up, that supply comes to demand. Elasticity does the same. Same things happen this year. Part of the reason we're tilting towards a global recession is because that energy spike from last year. So the best way to really measure demand destruction is on a lag versus the rate of change of price. And I've showed that a few times. And typical recession, what we get right now is typically global demand for crude oil drops around 5%. And that's been actually increasing in the past. So models are great. I really depend on my colleagues like you and Sally for that. And then I tilt back to the macro and say, what's really been driving this market? What's, the clients I've covered most of my life, what causes them to hit the finger, push that button to buy or sell? I'll point out one little thing here. Before we end, is never in the history of U.S. Purchasing Managers Index and service indices have they been in contraction, both of them, and the Fed's been tightening, and never in the history of the NASDAQ versus since its 200-week moving average could be calculated. It's only been through that level 3 times. Never has it been, it's at that level right now, 200-week moving average, has the Fed been tightening. So I view this as a 1929 type scenario. To me, this is the biggest global macroeconomic reset in our lifetimes. And to me, that's why I point out that 10 is the tightening into recession, and everything else is getting pushed below a 5 or lower, including Chinese, all the hopium for Chinese demand. So here's the one thing I'll leave you with. If you're that bullish on Chinese demand, buy the backs. That's the fronts and backs. When we trade futures, you can get $55 crude oil 5 years out, and WTI lock in no cost of storage. That's a very nice, attractive price if you think that demand's going to come back from China. So right now, those curves are mispriced for what people are talking about this demand to come back on.
Okay, so that's a very interesting idea you've laid out there, Mike. And Fernando, I want to come over to you. So, Mike, you just reiterated back on the China demand story, but one of Fernando, one of your big ideas for the year is that U.S. shale oil production could disappoint. So a pretty interesting perspective on the supply side, and maybe there's some macro things that Mike was talking about that feed into that. But tell us what you're seeing there, and also share your outlook for the commodity price this year.
So I actually agree a lot with Mike on the short-term drivers and the macro being potentially overstretched. When you look at China, they are going to reopen and stimulate the economy, but when you look at the average indebtedness of the Chinese consumer, it's so sky high, even compared to the Western standards, that you kind of question how much impact will that ultimately have. And then, as you said, we think the supply picture will emerge in the second half of the year. But then, with all the central banks tightening in the short term, our call from the last year was there is short-term headwinds to price that could eventually turn into tailwinds as we emerge from an eventual recession or a reversal in central bank policy. One of those, as you said, is the shale issues. We don't think that the inventory is there for shale to grow as fast as is expected, and we can continue to see this year after year, especially since the pandemic, where they miss targets. So right now, the EIA expects U.S. shale to grow 545,000 barrels a day in 2023. We think it will probably be closer to 200 to 300,000 barrels a day. And if it gets to Mike's points that we can get to $40 WTI, that's a non-starter. I mean, they're struggling to make a decent return at $70 forward, because remember, they typically takes anywhere between 45 to 90 days to drill a well. So you're usually hedging out that position, especially as a smaller private player. And that curve is in deep backwardation. So that 3-month forward is significantly lower than the spot price. And the inflation in other costs like the tubular goods, sand, and labor has been so large that the returns that they're making aren't as attractive as it's perceived if you just use the spot market. So the growth there will be very disappointing in our view. And if Mike's views play out, it's even worse. The big issue then becomes Russia, and we just saw today Vladimir Putin essentially declaring war, stepping up from a special operations to outright war in Ukraine, and we'll see how much there will be actions to lower Russian output, and all of that will contribute to a dearth in supply, which we will see emerge in the second half of the year. And then recession or no recession, I think this is, Mike's class project in 1976 is probably a good indicator, because we have a stagflation scenario, sky high rates, and a lack of supply. And it's not that we don't have the energy, it's that we don't have the energy right now. And that, I think, will be the big theme at the end of this year.
Okay, cool. I want to bring on Will Hares to comment on this, because I like the idea that the vision is that the market could be a lot tighter in the future. And in particular, I think I would note that, Will, many of the companies you cover, the European oil majors, are planning to reduce oil output over time, and they're shifting CapEx to clean energy and other things. Do you think that those energy transition type investments increase the potential that in some kind of medium term way we're in a supply scarcity looking out kind of in the few year range?
Well, thanks, Rob. I think it would be hard to argue against that when you're looking at the percentage of CapEx going into green and energy transition businesses for the European majors, which was 20% last year and will be almost certainly higher than that this year. And so I think it's hard to argue against that. Their oil and gas production would almost certainly be higher than it is today if these companies weren't investing in heavily and increasingly in energy transition. So yeah, I think that answers your question for you. On top of that, we've seen big divestment programs as well, and nearly all of these European majors will have already hit peak oil production or will hit peak oil production within the next few years. So certainly these companies are being much more disciplined. They're diversifying their long-term strategic focus and de-emphasizing oil production, particularly oil production, legacy oil production, which is not going to help the increasingly supply crunch scenario, which we see emerging in the second half of this year.
Okay, before we come back to get some thoughts from Mike, I want to swing to the gas side of the equation. And for that, I want to bring on Patricio. Patricio, we've seen a big pullback in European gas prices ever since the Russia's invasion of Ukraine. And it seems that we might be finding our new normal, but where's the gas market headed from where we are today? Give us your take.
Sure, thanks, Rob. I think a good way to summarize our view is that we're going to be probably playing sideways from now on for natural gas in Europe. We do see a range to keep prices 3 to 5 times their previous 5-year norm. So that would be roughly 60 to 100 euros per megawatt hour. That compares to an average price of 140 euros per megawatt hour in 2022 on average. But let's remember that 2022 saw volatility go up to prices with in excess of 350 euros per megawatt hour. And that was just that was inversely correlated to the Russian gas cuts, particularly during the time where the Nord Stream 1 pipeline was well, presumably sabotaged and suffered substantial damage. We do see a less volatile sort of price environment in 2023, and that's because Europe has done a very good job, I'd say, of replacing Russian gas volumes mainly with U.S. originated LNG and higher volumes from non-Russian pipe sources such as Norway and North Africa. The region has managed to replace about 80% of the Russian gas curtailments made over 2022. But at the same time, we've seen demand for gas in the region drop precipitously. We've seen our estimate is that European gas demand in 2022 will dip by about 15% versus 2021. And that is both weather related. So we've seen unseasonably mild weather in October, November, and December. All those periods were more than 20% lower versus 2021 in terms of weather-driven demand. And at the same time, we've seen also a big pullback in industrial gas use, and that is all price-driven. So that's what leads us to believe that Europe is somewhat past the worst of the crisis. But we do see sort of the 50 floor. I'd say that the 50 euro per megawatt could be a floor now that we are seeing demand for LNG in Asia pick up once again, and we're seeing the JKM benchmark in Asia sort of ticking up once again over the TTF in Europe. So that tells us that perhaps that 50 to 60 range is perhaps the bottom. And as we go into the summer reinjection season, the fundamentals driving, I think, most of the prices here in Europe will be sort of pulling that demand away from Asia. So it is pretty much open to the reopening. Sorry for reiterating, for the reopening in China, really, and how that will play out into gas demand during the summer.
Okay, Mike, I want to come back to you on the gas side of the equation, and I'll just say that you're constantly putting out notes that with very provocative headlines on the terminal. So just the other day, you had crude at 40, natural gas at $2. So I know Patricio is really walking through the European perspective, and I think you've take a closer look at Henry Hub. But give us a sense, where's Henry Hub headed, and how does it feed into this kind of European gas crisis story that we've got going on? I would say that we're very thankful here in Europe that U.S. LNG has been able to really pick up the slack for us. Otherwise, this winter would have been a very difficult one.
So what you just experienced last year was probably the worst energy crisis of our lifetimes, maybe yours too. I lived through the ones in the 70s. I remember very well trading in 1990, and that crisis you saw with that war was very unusual. And look how we've responded. How it typically takes how many years for LNG imports to come on in Germany? Done in 200 days. Don't underestimate humans and necessity. And what I'm showing you is one chart. Gas is a significant part of it. I'll get to that second. It's just one simple chart. I expect it's just a Bloomberg Commodity Index going back to since right when I was born in the early 60s. Versus this 40. I'm messing with you because I'm just an old fart. And guys, I've seen the pain from people who get bullish commodities when they shouldn't be. And I just seen it. I mean, I've seen guys lose their jobs and everything. I've seen it from firms going under. Barclays is one of them. Goldman Sachs Commodities Group decimated because they did it the wrong time. It's all about timing. So what I just show you, this is the Bloomberg Commodity Index divided by the 41th moving average. I'm roping natural gas. At its peak in August, we wrote about it. If you rebalance the index that day, natural gas, the Henry Hub would have been the greatest weight in the Bloomberg Commodity Index ever. It was just an example of extremes. 10 was too expensive. 4 is too expensive. 3 right now is probably good. The average cost of natural gas in the U.S. is $2, and the world's largest exporter of LNG. Boom. You know what the rule in commodities is you always go to the cost of production, particularly in recessions. So what I show you in this chart is never have we had a spike in energy like we had last year in commodities without a recession. Now, I only can measure U.S., and never have we had a recession with the Fed hiking rates. The Fed's still hiking rates. Back to square one. That's the 10 in the room. So I like to point out natural gas there. And also, I do like this narrative about China and the demand. And that's the case. This is the bloom. If that's the case, this is your opportunity. If that's the case, this is the crude oil curve. You can go on this curve. And the rule in futures is it's cash plus carry. So the carry now on average crude oil is T-bill rates 4%. So it should be 4% higher. And then the cost of carry, typical average cost of storing crude oil is sometimes 8%. So that curve should be showing that. That to me is the opportunity for anybody who believes in that. Buy the curve, buy those out. You should be investing in those back futures. Now there's indices that do that. To me, so that's my point. If we're going to come up with views, here's the strategy. So the strategy to me with China reopening is, I want to point out the key thing about China is that property crisis is epic. That's from it's still got another 25% to go. Quote from one of our strategists who have to be very careful when they're based in China. And I view China as a combination of what happened with the Soviet Union and Japan about 30 years ago. Japan just got too expensive, and still we're in that the hangover from that. And the Soviet Union autocratic leaders just never work in major economies expanding. And so I think China's peaked, and I've been saying that for years.
Okay, very, very interesting perspective on the gas market. We do have a question in the chat, so anyone listening, feel free to ask a question. We'll try to get to it. And I think there's a tie-in here, particularly on the China story. And the question relates to outlook on refining, and it was particularly interested in diesel cracks. And I think both Fernando and Sally will have some perspective on that. Sally, we'll come to you first.
Sure, I'm just reading the question. Refining diesel cracks. Yeah, I mean, I think at least for the European refining space, what we expect is a decent year for refiners, decent refining margins compared to historical averages, but we don't expect it to be as good as the second quarter. In the second quarter, what we saw is that supply crunch really boosting crack spreads and refining margins for the European refiners. So with the European Union embargo coming for the oil products on February 5, this will be especially disruptive for diesel, because as you know, Russia exports a lot of diesel into Europe. And what I was talking about earlier on how disruption to Russian crude has been very limited, and that's been partly because Russia was able to reroute a lot of that crude that it's normally used to send to Europe to other markets in Asia, especially China and India. It's going to be a lot more difficult to do that with diesel because of just where the refineries sit and because of infrastructure. And that's why we expect a part of the diesel supply from Russia to eventually be shut in. So with that in mind, we think that even though crack spreads for pretty much all products are not going to be as good as earlier in 2022, they will come down, but especially diesel crack spreads, we expect to be relatively relatively strong because of this supply shock. But I'll let Fernando speak about it too, perhaps on a global scale.
I tend to agree with Sally. Also add that most of the growth in oil production has been the light and ultralight, which have a much higher gasoline content. When you lose Urals from Russia, you're also losing a high distillate content. And so the opportunity to replace that will be very limited. I'll say that in the short term, you have even more pressure on gasoline with Chinese refineries coming back to the export markets. They just released very significant export quotas for a lot of their refiners, so that tends to really push crack spreads out in the South China Sea and the Pacific market in general. Also worth noting that gasoline on a traditional benchmark has twice the weight as diesel. So as Sally said, the crack spreads are likely to come down significantly relative to 2022 levels, which are already very elevated. But when we look at the margins in the U.S., we still think they'll be very healthy. We had a lot of shut-ins just now because of the deep freeze in the U.S. It contributed to a normalization of the inventory declines, and that in itself should see U.S. refining margins remain relatively robust above what we call the mid-cycle for the most of the year, if not all of it, barring a cataclysmic event like Mike has described, the 1929 level of recession that would really pulverize crack spread, especially for gasoline.
Okay, thank you, Fernando. We're going to run over just a few minutes here. Before we conclude, I will just do a quick advert. If you pick up your latest copy of Business Week, normally BI content is not in Business Week, but we did identify 50 companies to watch. We do this every year. Will's got Aker BP. Sally's got ADNOC Distribution. I picked Vestas, the world's largest wind turbine maker. So make sure to check it out and see why we are looking at these companies. And we do this every year, and it holds us accountable. We put a line in the sand and say, look at this company. So anyhow, go look at that. But before we conclude, and Mike, we're going to give you the last word, so you're going to be last. But we've had a great discussion here today. We'll be getting back together in about 2 weeks. So Patricio, we're going to come to you first, but what's your concluding thought for the day? And in the interim here, what are you watching right now? What kind of catalyst are you looking for that might move the companies and our markets of your concern? So Patricio, to you first.
So I think for my sector, the key catalyst is if we do in fact enter this de facto recession that we've been talking about now. I think that will be fairly will make my sector relatively more in favor, because utilities in Europe tend to be recession not proof, but I'd say very resilient, given most of their returns are indexed to inflation, and regulators allow them to recuperate or recover increased borrowing costs over time. So that's a key catalyst for my sector for sure. And the other one is looking at the fourth quarter and the first quarter of this year will be at what I expect to be an improvement in energy retail margins, and that's because of this sort of sweet spot of declining wholesale gas and power prices. But at the same time, you have to remember my companies mostly hedge their sales forward, and they probably achieved hedges that are above the price levels that we're seeing on the wholesale market today. So this could actually be sort of a silver lining for the earnings of some of the integrated utilities here in Europe.
Fantastic. Will, same question over to you.
Yeah, I'm going to be looking at the 2023 budgeting for the oil majors, in particular, taking a look at the shareholder returns programs that they have. Keep in mind, buybacks were absolutely enormous last year for the European majors, nearly 50 billion in aggregate. I don't expect it to be near those levels this year. Probably somewhere between 30, maybe 40. And also continued gradual dividend recovery, but I'll also be looking at the capital discipline on the spending. Expect things to maybe bump up a little bit, but still remain highly disciplined and see that share of energy transition capex continue to climb gradually, and we might even see a big M&A deal this year. The conditions are looking ripe.
Okay, Sally, you're next.
Yeah, so a couple of things that I am watching. One, mobility data in China. I mean, as we discussed, like there is a lot of uncertainty about this big reopening in China. We don't really know how that's going to go exactly, but mobility data in China. Secondly, exports from Russia. Again, something that I mentioned a couple of times already. What kind of disruption we should expect for the crude market, especially from Russia. But then a few things I think that might, add to our thesis is kind of like whispers of dovishness from the Fed. So what happens with the Fed policy will be very important. Any more sanctions on Russia? I mean, I don't know if secondary sanctions will be considered or announced at some point this year. But also, I mean, something we haven't talked about today, but the strategic reserve releases are coming to an end, I believe, this week. So this is something that we're watching to see if there will be more of them, if they will be refilled now. This can be quite significant for the market as well. So just a couple of the things, a couple of the major things that we'll be watching this year.
Fernando, you're up next.
Two key things. The first one is the Japanese yen and the BOJ. Mike and you alluded to the role of the dollar, and they're trying to defend their peg now. If that breaks, that could have a significant impact on the dollar valuation and then consequently on oil prices. And then secondarily, within the next couple of weeks, we'll start getting some of the fourth quarter results, seeing the level of buyback, especially for refiners who are finally through cleaning up their balance sheets, and then their first quarter guidance to kind of allude to the strength that you see in the physical market relative to the paper markets for the refining side. Those will be critical to kind of gauging where we are starting the year at.
Okay, I'm going to give you a quick one too before we come to Mike. So if we see these recessionary pressures play out, and if we see that translate into a bearish view in commodities, I think it potentially translates into a decent story for the wind and solar folks. So we've seen polysilicon prices, commodity, fall about 50% in the last month and a half, let's say. Steel prices, a key input for the wind industry, they're down about 50% from hitting the peak last March. And I think demand for wind and solar, even in a recession, is going to be strong. There's all kinds of policy support. Come talk to me if you want to do that. So you got strong demand, you've got declining input costs for those industries, which creates the conditions for better profitability for the manufacturers. So take a look at our analysis there, and then I'm going to come over to you, Mike, to close us out with your macro commodity view. And I just will thank you in advance for joining us here today. It's always a pleasure to get your perspective.
Thank you. I appreciate you and all my colleagues for helping guide me and make me sound and feel smarter. So really appreciate that. And a key thing I want to leave you with is fade the Malthusians and focus on the rules of Adam Smith and the invisible hand. The Malthusians have been wrong for 300 years. And the key thing, headline I liked is people are smart, commodities aren't. Focus on the equities. You guys are smart and do it. If you're bullish commodities, equities and companies will be able to make profits from those commodities, and by doing so, they will create more and more of them at cheaper cost and make money and pressure prices lower. That's the history of mankind. It's just accelerating. So there's two books I suggest to people who are bullish commodities to take a look at. One I read too early, a couple of years ago, called The Price of Tomorrow by Jeff Booth, and another one I'm reading right now called Superabundance. And it's just focused on how wrong the Malthusians were. So the key thing I'll leave you with this in the short term is, ask you and yourselves and our clients and our listeners, what stops this process of right now the trajectories for global GDP, just look at the latest from the World Bank, are downward. And we have the most central banks in history tightening. That is a 1929-ish scenario. That's a depression kicking in. Something's got to flip that switch. Typically, it's massive liquidity via Fed ease, central bank easing, and or lower plateau and all risk assets. I think it's going to be both. Crude oil is a big part of it. Like I said, I expect WTI to get closer to 50 and the S&P 500 to get closer to 3,000, which is normal based on what it says on the VIX, 20%. So I leave you with that.
Awesome. Thank you so much. I want to thank everyone for listening today. Reach out to any one of us. We're very easily found on the Bloomberg terminal, and we're happy to engage with you on any of the topics we've discussed here today. And we hope to be in touch. So I hope everyone has a great rest of their January, and we look forward to talking to you again on the first Wednesday of February. Take care.